Imagine buying a beautiful house, and instead of letting tenants live in it, you leave it sitting empty for years, hoping someone pays more. If you did that with real estate, your friends would tell you you're throwing money away. But if you look at your brokerage account right now, there's a good chance you are doing the exact same thing with your stocks. Take a look at this chart showing a typical sideways market. The price bounces around day after day, but ultimately goes nowhere. You hesitate to sell in case it suddenly goes up, but holding is painful because your money is trapped, not earning a dime. Professional traders don't tolerate dead equity. When their holdings get stuck in the mud, they put those dormant assets to work. They use a tool called a covered call. You don't need to memorize that term, though. It is much easier to just think of it as the stock rental strategy. By setting up a simple rental agreement on the shares you already own, you can start collecting guaranteed cash today, even if the stock price never moves another inch. To set up one of these rental agreements, there's only one strict rule. You must own exactly 100 shares of a specific company. So let's use NVIDIA as our example. Here is our starting point. You own 100 NVIDIA shares at $120. Expecting sideways movement, you offer a deal to sell at $130. In exchange, a $300 fee is immediately deposited into your account. That $300 is yours to keep forever. It doesn't matter if NVIDIA stock crashes tomorrow or stays flat for the rest of the year. Nobody can ask for that rent back. By simply agreeing to a future selling condition, you have generated a brand new stream of income, while everyone else is still waiting for the stock to rise. Fast forward to the end of your contract. This graphic shows the only two possible ways this plays out, depending entirely on whether the stock crossed that $130 line. In scenario A, the stock finishes below your target at $125. The contract vanishes. You keep your 100 shares, keep the $300 rent, and are free to rent them out again. In scenario B, NVIDIA surges to $135. Because you promised to sell at $130, you hand over the shares. You capture a $1,000 profit plus the $300 rent, walking away with $1,300. Whether the stock sits perfectly still or moves up and gets sold, the upfront rent buffers your account and guarantees you get paid. There is, of course, a catch to the math. What if NVIDIA doesn't just reach 135, but absolutely skyrockets to 150? This chart shows the trade-off. Even though the stock hit 150, your contract legally binds you to sell at 130. You miss out on that extra $20 per share of profit. That is the core philosophy at work. You are choosing to trade away the slim chance of a massive sudden gain for the mathematical certainty of stable cash today. That makes this specific approach highly effective in choppy, high-level markets. When stocks are surviving but struggling to break out, hoping for a sudden rally is miserable. You don't have to be a passive passenger in the market. You can step into the role of a landlord, putting your portfolio to work. The best part is, this single rental contract is just the first half of the equation. Next time, we'll look at how to chain this together with another tactic to form an endless, repeating income loop, known as the wheel strategy.